So are we doing equity start solving?
Yeah.
Okay.
Which question you said?
18th one, Pierre Louis. Page number 71.
71.
Yeah.
Question number 18, right? Okay.
Yeah, Pierre Louis.
This you both can see, right? Okay.
Yes.
Purchased a call option. Just purchased a call option. Robert just purchased a call option on shares of Michelin Group. A few days ago, he wrote a put option. So just purchased a call. That means there is call options. So there is call options. In call option, he is the holder. Because he purchased. Okay, so he is the holder. That means he expected the price to go up. Okay. Then few days ago, he wrote a put option. So now he purchased call. Okay, just purchased call. A few days ago, he wrote a put. So this is before and this is after kind of thing. Okay. So before what happened, he wrote one put options. So now there was one holder and there is a writer. So here also he wrote a put option, right? Okay. Few days ago he wrote a put option on Michelin shares. The call and put option have the same exercise price. Okay, 100.
So it is long.
So here he is long on call and he is short on put. In put he is short.
Okay.
The call and put options have the same exercise price, expiration date, and the number of shares underlying. Considering both positions, Robert's exposure to the risk of the stock of the Michelin is he is long. So long means here he believes that the price will go up. About stock. When I say he is long on stock, that means he believes that the price will go up. No?
Yeah, like in both the cases, he's expecting the prices to go up. Yes.
Yes. So it is A.
But still, in put, he's short on put, right?
Yeah, he is short on put, but he is long on the stock.
Okay, so that's why the answer is long. A.
Long. Yeah.
Okay, I'll just say.
Shravan, you understood this?
Yes, sir.
Yeah. What is the next doubt? Next doubt.
Yes, sir. Yes. So can you do the 22nd one? 22nd.
Okay. Carolyn Rogers believes the price of Gamma Corp stock will go down in the near future. She has decided to sell short 200 shares of Gamma Corp. Okay. So you are shorting. So this is not derivatives, right? So now will go down in the near future. So sell short. So short selling. Short selling 200 shares at the current market price of 47. 47 is the price. 200 shares at the current market price of 47. The initial margin requirement is 40%. Okay. So what is 40%? So what is the total amount? 200 into 47, calculate.
It's 9,400.
And so initial margin is 40%.
40%.
So what
It's
is 40%?
3760.
3760 is the initial margin. Okay.
Second price equals E.
Which of the following is an appropriate statement regarding the margin requirement that Rogers is subject to on this short sale? She will need to contribute 3760 as margin. Initial margin.
Okay, this is the
This is it, no?
question.
She will
Yeah.
need to contribute 56, no, 3760. She will only need to leave the proceeds from the short sale as deposit and does not need to contribute. Yeah, okay. A.
Yeah, and 23rd.
You're checking the answers also, right?
Yeah, yeah.
Okay. Yeah. Then the current. Okay, now next one. The current price of your stock is. The current price of your stock is 25. You have 10,000 rupees to invest. You borrow an additional 10,000 from your broker and invest 20,000 in the stock. If the maintenance margin is 30%, at what price call? This is direct uh, formula, margin call. What is at what price will your margin call first happen? So margin call, we did this in this is a direct formula only. So the formula is P0 into 1 minus initial margin divided by 1 minus maintenance margin. So P0 25 per share. Current price is 25. 1 minus initial margin is how much? 50%, because total 20,000, we are investing 10,000. So 50% divided by 1 minus maintenance margin is
30%.
30%. Yeah, calculate all this now.
Seventeen 17.857. Yes, it's B.
Hmm.
Okay.
What is the next one?
Yeah, it's leads. 22, 24. 33rd.
Okay. 33rd. Consider an order-driven system that allows hidden orders. The following 4 sell orders on your particular stock are currently in the system. Okay, so all these are sell orders in the system's limit order book based on the commonly used order precedence hierarchy. Which of these orders will this precedence have over others? Will have precedence over others. Order 1, 2, 3, 4. Limit price. See, selling order. So selling order means which price should come to which is the best one, the highest price or the lowest price? If you are a very serious
Lowest.
seller, yeah, if you are a very serious seller, you will sell at the lowest price, right?
Like there are
So,
3 prices then, right? 20.29.
so out of all this 20.89, okay. So 20.89, within 20.89, hidden order will be given last
It's
preference.
20.29, no?
20.29, sorry. So in 20.29, hidden order will get the last preference. So
Okay.
now it is between 3 and 4. Now
3 and 4.
between 3 and 4, both are same. So time preference will come next
Yeah.
because amount is same. So time perspective, who came first?
So it will be third, right?
953, third. Yeah.
Third. Okay, I'll just check.
So 3, right? So that is order 3.
Got it.
Okay, next one.
So no more in this chapter.
Okay.
So the next.
So next chapter.
Yes, sir. I'm going to the next chapter. The fourth one, sir. I think it's a memory based one.
Page
Page
number.
triple one.
Triple
Triple
one.
one. Yeah. 1 1.
Question number.
Question number, yeah, third. Third and fourth.
Third.
These are memory based ones, right? I think I'll have to-
Third one, the value of a price return index and a total return index consisting of identical equal weighted dividend paying equities will be equal only at inception, and on rebalancing dates, at inception and on reconstitution dates. The value of price return index and a total return index consisting of identical equal weighted dividend paying equities will be equal only at inception and on rebalancing dates, at inception and at reconstitution dates. The value of your price return index. Okay.
So in a price return index, do we
And total,
consider dividends?
only price we consider. We don't consider
So
dividend
say
for
like at this starting, it's only
price.
same and
Yeah.
because
Yeah, it looks like A, but hold on, wait. The value of your price return index and your total return index consisting of identical equal weighted dividend paying equities. If we rebalancing and or reconstitution dates. So if we rebalance
it's
or
E, right? Because they'll
reconstitution.
consider dividends and all, like at the time of rebalancing and reconstitution.
So when we rebalance uh, total return index and price return index, the value of your price return index and your total return index. Okay, price return is okay. Total return on rebalancing date, the values of your price return index and the total return index. It is rebalancing. So let's say, for example, from 100, it has gone to 110 in 1 month, and the dividend is 1 rupee dividend. So 111 total return. And then when we rebalance, we rebalance as in we are having 110. Acha, it has to be only correct. It has to be only inception because again this stock will be influenced by the dividends. Should be A. Is it A? I'm not deadly very sure though. Is it A?
I think it's C. I'd mark
Just
E.
check.
I'll just check it out.
Just check.
So, yeah, it's C. At
Yeah.
inception, the values of the
Yeah.
price return and total return versions of an index are equal. That's what
Yeah.
they're.
Inception is correct. Why not B and C is like when we rebalance.
Hmm.
So when we rebalance, this stock again is influenced by dividends that will
Dividends.
be paid
Yes.
in future.
Yeah.
So again, when we move ahead, again the price will fall down once the dividend is paid here. So again, it is not, the equality is not existing between price return and total return index. Okay. Okay, fine. What is the next one?
The next one, fourth one.
Security market indexes are constructed and managed like a portfolio of securities. Um, Security market, simple interchangeable tools for measuring the returns of different asset classes. Interchangeable tools? No. Valued on a regular basis using the actual market prices of the constant. Constructed and managed like a portfolio of securities. Valued on a regular basis using the actual market prices of the constituent security. Should be C. Security market indexes, no?
Oh, no,
Actual
it's C.
constructed and managed like a portfolio.
Yeah.
Okay. So what is the explanation? Let me see. Fourth one. Only this much they have given.
Yeah, like,
Security market indexes are constructed and managed.
but they can
Okay.
be wrong, right?
Like a portfolio of securities. Why do you say wrong?
Uh,
Security market okay. are valued on a regular security market indexes are valued on a regular basis using actual market prices of the constituents securities
I
constructed
don't know.
and
I
managed.
just like C sounds better. Point C.
Um, okay, let's try to find out security market indexes. Security market. See here, most indexes are constructed as a portfolio of marketable securities. Most indexes are constructed as a portfolio of marketable securities. Represents given security market segment constructed as a portfolio of marketable securities. It's a theory. Sir, further they are speaking something, right? The value of an index is calculated on a regular basis using either the actual or the estimated market price known as constituent securities. So index represents portfolios of securities and the value of an index is uh, value calculated on a regular basis. Okay.
That is A.
Where is that question gone? Fourth question, right?
Yes, page 111.
Yeah.
The fourth one.
So why not? Actually, estimated price they gave, right? Wait again. I think.
Here they've said actual.
Yeah, that is the problem.
Okay.
It's a theory again.
And is this line there in that para like constructed and managed like a portfolio of securities? Okay, yeah. Constructed as portfolio of marketable securities.
So 1 second. Just took the screenshot. We'll see this. So let's see the differences here. Security market indexes represents a given security. Okay, why not this part? The value of an index is calculated on a regular basis using either the actual or estimated market price of the individual securities. The value of the index is calculated on a regular basis using either the actual or estimated market price of the individual securities, valued on a regular basis using the actual
So,
market price.
what do they mean by constituent securities? Like,
That means
here,
all the ingredients, all the parts of that index, all the
and
all
here
the
they are saying individual, right? So,
where are they saying individual?
here they're saying individual securities in the like in the explanation, and
Okay,
the point
estimated
is,
prices of the individual securities,
and
actual
here they're saying
prices of
constituent
the
securities
constituent securities.
in the question. So,
Oh, okay. Let me read again then. The value of an index is calculated on a regular basis using either the actual or estimated market price of the individual securities, known as constituent securities. Estimated market price of the individual securities known as constituent securities. No, that individual securities is only constituent securities. So valued on a regular basis using the actual
like it's the
market
same
price of
thing.
the yeah, it's the same thing. It is only because it is actual mentioned that is the problem.
Okay, so like both
Yeah,
should have been there,
yeah,
like both
actual or
or
estimated.
estimated. Okay.
Okay, it's a theory within the index. Okay, two versions of the same index. An index with identical constant securities and weights. One version based on price and one version based on total return. Price return. Okay. So here the problem is estimated word is not there. Otherwise, it is also right. Security market indexes are valued using estimated market price of the individual securities. Hmm. Okay. Okay, it's a theory. Okay, and I'm also wondering like what would be the example? Like estimated means what are they referring to? There is no explanation also. Security market index. Security market index. So estimated means uh, it can be about let's say fund. Yeah, mutual funds. There it is estimated. That can be taken as the example. Like fund of fund is investing in another fund. But again, an index. Okay. So maybe abroad there are some indexes where like a fund they are calculating and published now. Okay. What is the next one?
So the sixth one, price return.
Hmm.
So we get the averages, and then
Hmm.
like here, like while calculating price return,
Mm-hmm.
it's like the price is divided like 10 plus 20 plus 30 by 3, and then 12 plus 19 plus 30 by 3. That's how we do it, right?
No, I haven't understood. Wow, say it
Like
again.
how do how we find the percentage change, right?
Huh.
So we get the averages of all the prices in a price return.
No, in price, okay, in price return, all we are going to do is we will focus on the price. Say, for example, uh, this is 100, 100 has become 110. and then 50 or 80 has become 85, and 50 has become, let's say, 52, and dividend of 2 rupees, 1 rupee, 1 rupee. Now in price written, now I'm going to focus only on the price in price written. Okay, and then within that, there is equal weighted, price weighted return, equal weighted return, price weighted return, equal weighted return, and market capitalization weighted returns, right? Suppose if this is price weighted, I will focus only on the price now. So what is the average price of this one? What is the average price of this one? So, so you take average of this and average of this. We will ignore the dividend. Okay, just take the average of first part, 100, 80 and 50.
76.67.
And this part,
It's 82.33.
so weighted average is what? 82.33 divided by 76.67
So it's 7.38%
minus 1,
into 100.
7 point, yeah, 38%. That's it. If this is weighted price weighted average,
Okay.
if this would have been total return price weighted average, then
we would have
total will be
factored in the
102,
dividend.
86, 53. Then I would have taken this average. Calculate this one.
Okay. 83.67.
83.67.
So
So
9.12%.
83.67.
9.13. Sorry.
9.13.
13. Okay, this one here is an equal weighted.
This is
6.
no. This is price weighted index. Price weighted. Now, if this would have been equal weighted, then what I would have done is, so let's say again same number. Price weighted. So no, equal weighted. So 100, 80, 50. 110, 85 and 52. 2, 1, 1. Now I will ignore price. I will ignore dividend because it is, I have to calculate the price return of an equal weighted index. Okay, price return of an equal weighted index will be,
If they would have said total return of an equal weighted, then we would have
then I
considered
would have included dividend as well.
Okay.
So now this is 110 divided by 100 minus 1. Convert all into percentage. 85 divided by 80 minus 1. 52 divided by 50 minus 1. Convert all into percentage.
The first one is 10%. Then second one is 6.25. Yeah, it's 4%.
So it is equal weighted. So 10 percentage plus 6.25 percentage plus 4 percentage divided by 3.
5 divided by 6.25. Yeah, it's 6.75.
Okay, if they would have said total weighted index, then 112 divided by 100, right? This also I would have taken. Just calculate now. 86 divided by 80. Then this one is 53 divided by 50.
12%. 7.5%.
12%, 7.5%,
6%.
okay. So now 12% plus 7.5% plus 6% divided by 3.
8.5%. Got it.
Okay. If this would have been market capitalization, then again we will include the number of shares over there and
Okay.
the number of shares
So that time
and the
they'll give
price.
us the number of shares.
Number of shares will be given. Okay.
And also we'll take in dividends, right?
No, we will be just again focusing on market capitalization, right? Market capitalization is number of shares and price only, not
Yeah.
the dividend.
Multiply with the new price. Right?
Yeah, yeah.
Upon.
Only the price we will take there.
Got it. Yes, I'll do it later.
Okay, fine. Okay.
These questions I'll do them later.
Okay, what is the next question then? Next doubt.
Yes, just a minute. 11th one.
Yeah. Eleventh one. When creating a security market index, the target market. When creating a security market index, the target market determines the investment universe, is usually a broadly defined asset class, determines the number of securities to be included in the index, not the number of securities. Um, Target, when creating a security market index, the target is usually a broad defined, no, it is not asset class, investment universe it should be. Okay. 11th one, let's see.
Yeah, it's A.
A only, no? Yeah.
It's A.
That is because you think about Nifty index. Now it is not defining that only this particular asset class should be there.
Okay.
Okay. Any asset class which is based on market capitalization, let's say. So
Right.
any asset class is fine, right? What is that question number?
11th.
The investment universe.
Yeah.
Okay. So any from that, any, it is not specifying that only this particular index I am going to take or this particular asset class I am going to take. Okay.
Yes.
Okay, what is the next one? So it is not going to even specify number of securities to be included. So this is clearly out.
So in the 12th one, right, we won't look at the shares, right? Shares outstanding, because it's price weighted index.
Yes.
We'll just
Price weighted index. Yeah.
get the
So
average of the prices, right?
yeah. Price weighted index. So
Okay.
number of shares is just to confuse us. And yeah, so only you will look at the price. You can quickly do this now. Take the average 20, 50, 26. Take the average. So because it said price weighted index. Okay, price weighted index, and they said price return. So there is no dividend given as well. So price return and price weighted index, these two words are important. Okay, price weighted index or equal weighted index, price return or total return, that way you have to see. Just quickly calculate 20 plus 50 plus 26, how much?
96 divided by 3, 32.
32. And here 22, 48, 30 is how much?
38, 100 by 3. So
Huh?
33.33. 100. It adds up to 100. So
Right? That's it.
33.33 divided by 32. So it's a 4.2%.
That's it.
Yeah. Okay.
Next one.
Yes. So what is value weighted index?
Market
The
capitalization only.
13th one. Okay. I'll have to.
Market capitalization only. Market capitalization. Value weighted index means market capitalization.
Yeah.
Here number of shares also will come into play. Okay, so new market capitalization divided by old, right? So new,
Yeah.
you will multiply these two and add up all this and divide by this part.
15th one. So
Which
yeah.
of the following index weighting method requires an adjustments to the divisor after a stock split?
It is when we do equal weighted method, right? When there's a
Uh-huh.
stock.
Uh-huh.
Like the divisor changes when we it is equal weighted method, right? And there's a stock split.
No, no, no. That one is price weighted index, no?
Okay.
Where the divisor will change. That is price weighted index.
So this is A. So the answer
This
is
is,
A.
yeah,
Okay.
price weighting. You remember, or should I show that page to you?
Yeah, can you show it, sir?
Okay. See, price weighted index and this divisor sum. Is it okay? Hello?
Yes, sir. Yes, sir.
This is fine? This sum.
Yes.
Okay, next one.
Sixteenth one, sir.
Question number
16. 16. The
16.
next one. Yeah.
If the price written of an
Sixteenth one, sir.
yeah. If the price return of an equal weighted index exceeds that of a market capitalization weighted index. If the price return of an equal weighted index exceeds that of your market capitalization weighted index comprised of the same securities. Okay. The most likely explanation is stock split, dividend distribution, outperformance of small market capitalization. If the price return of an equal weighted index is exceeding that of the market capitalization weighted index, mm, comprised of the same securities. So that means market capitalization is lower. So
Yes. Like there are same
the
concept
price
as
is the
securities, right?
same. So number of shares will be lower in market capitalization. Okay. The most likely explanation is if I think about C, outperformance of small market capitalization. Uh,
I think
yes,
it can
that
be C, right?
yeah,
Which term?
it gives more importance to small cap. They get the advantage, right? Yeah, it should be C. Just check.
Yes.
Yeah, because it gives importance to more importance to small cap. No?
Yeah, it's C.
Yeah,
Like it will affect more, like the prices of the movement of the small cap stocks, right?
yeah. Small cap will get the benefit. Yeah.
Okay. Even if they have the same proportion of large cap ones.
Same
Like
proportion of.
let's say if it's an equal weighted and it consists of 50% of large cap and 50% of small cap.
Mm-hmm.
So like the small cap will
Will get more benefit
movement.
there.
Okay.
Okay. Because you are investing, let's say 100 rupees in both. So small cap will be getting more, no? More in the sense one is, let's say, one is 100 rupees and one is large cap is 100 rupees, small cap is 20 rupees.
Yeah.
So 20 rupee shares are, more cash inflow is coming in. So they will outperform them. Okay. Okay. This is fine, right? The next one.
18th one.
Okay. Which of the following index weighting methods is most likely subject to a value tilt? Value tilt is fundamental weighting, no? Fundamental towards value, fundamental weighting.
Can you explain? Sorry. Hello.
Yeah. So fundamental weighting.
Fundamental weighting is market.
This one. Value tilt. See this one. Value tilt. Can you see this word?
Yes. Fundamental index will actually.
Okay.
It is because of the ratios and like
Yeah. They give value means here cash flow, EPS, all such values.
okay. So like it is more sensitive, like the most sensitive is it like, amongst all others.
Value will be given more weightage. Yeah. So okay, you are saying which is more sensitive than price weighted.
Is more.
Every day the price on that basis only we are calculating, right? Okay, what is the next one? Shravani, you have questions? Have you done all this?
Yes, sir. I don't have question in this chapter. I have in the last chapters.
Acha, okay. Okay. Yeah, Subhajit, what is the next doubt?
22nd one.
Security market indexes are used as uh, security market indexes, okay, are used as a measure of investment returns, proxies to measure unsystematic risk. proxies for specific asset classes in asset allocation models. Security market indexes are used as measure of investment returns. Proxies to measure not unsystematic risk. Proxies for specific asset class in security measurement of investment returns only. Proxies for specific asset class, no. Investment returns, that's what we saw at investment universe. Just check.
No, it's C. Proxies for
See, they are
specific
saying.
asset classes. Yeah.
Okay, let me read the answer then. C is 22nd. Proxy for asset classes in asset allocation models. Security market indexes play a critical role. Security market indexes play a critical role as proxies for asset classes in asset allocation models. Security market indexes play a critical role as proxies for asset classes. Okay. In asset allocation models. Okay, again, theory. Security market indexes play a critical role as proxies for asset classes. Okay.
Like, what do they mean? Proxies for specific.
Yeah, that's what I'm. Wait, I'm going to check now. I just took the screenshot. Okay. So, crucial role as proxies for asset classes in asset allocation model. So, asset allocation means, say for example, you have decided to put 60% of the money into equities. So, security market indexes play a crucial role as proxy for asset classes. Okay, so why not others then? What is that question number? 22. Okay. Security market indexes are used as proxies for asset, used as measures of investment return. Second one we can eliminate. Why not the first one? As a measure of investment returns. Proxies for a specific asset class in asset allocation models. Measures of investment return. Security market indexes are used as measure of investment returns. Okay, I'll just keep this question aside. I'll take this screenshot because I'm not able to find the reason, like why not A. Okay, let it be. I'll just think about it. Okay, I'll just mark it as doubt.
Okay, sir. And the 24th one. Which of the following statements?
24th.
Yeah, which of the following statements regarding? sector indexes is most
Yeah,
accurate.
which are the following statement regarding sector indices is most accurate? Sector indexes track different economic sectors and cannot be aggregated. Different economic sector. They provide means to determine whether an active investment manager is more successful at stock selection or sector allocation. Apply a universally agreed upon sector classification system to identify constituent securities of specific economic sectors such as consumer goods, energy, finance, healthcare. Which are the following statement regarding sector indexes is most accurate? Sector indexes apply a universally agreed upon sector classification system to identify constituent securities of specific economic sectors such as consumer goods, energy, finance, healthcare. Universally agreed upon sector classification system to identify constituent securities. This I doubt universally accepted. Okay. They provide means to determine whether an active investment manager is more successful at stock selection or sectors allocation. Sector allocation, um, no, again, I doubt. Sector allocation, this is possible. Okay. Track different economic sectors and cannot be aggregated. No, it should be B then. Just check if it is B.
It's B.
B, right? Yeah. Okay. Yeah, that is because see, first one track different economic sectors and cannot be aggregated. It is not tracking different economic sector. If it is banking index, it is just tracking all banking side, no?
Yeah. Yeah.
Uh, yeah, yeah. So that's why first one will not come. Third one, universally agreed upon. Again, it is not universally agreed upon because certain companies, it will be very difficult to find out which sector it falls into. Say, for example, now before ITC got demerged, it was into majorly it was into consumer, but it was into hotel sector as well, right? So, and there are certain companies which is like equally distributed. There are also, it becomes very difficult, like to find out like which sector it is into. It will be into infrastructure. It will be into, uh, um, real estate. Uh, so it is a pure real estate player or pure IT company or pure banking. It becomes little difficult.
Like a conglomerate, right?
Conglomerates all will be there, right? Conglomerate companies.
So we
So,
can't like specify it like say it as into one sector. It
yes, yeah,
won't belong to any one sector.
yeah, yeah. Okay. Then provides a means to determine whether an active investment manager is more successful at stock selection or sector selection. So why this is the one? Because sector indexes provides a means to determine whether an active investment manager is more successful at stock or sector. See, what happens here is, when imagine you are an investment manager, you will learn about this more in the level 2. In level 2 you have this topic, stock selections and sector selections, wherein, let's say, the benchmark index has given 12 percentage and you have given 15 percentage return. So that 3 percentage extra that is coming, we will allocate it to your stock selection ability or your sector selection ability. So their sector indexes will be useful. Okay. I think you will understand better that later stage. In level 2 it is there. I don't know how they have put up all that in level 1, this one. But now, just on the surface, theoretically, you understand
Yeah,
that
I got it.
sector indexes, active investment manager is more, they will be able to bifurcate between stock selection and sector selections. Okay.
Yes.
What is the next one?
27 fixed income index.
An aggregate fixed income index. This one. Okay.
Yes, sir.
An aggregate fixed income index comprises of corporate and asset-backed securities. Represents market of, it's an aggregate, right? So why only market? So why only government issued security? So B will not come. Can be
So is it
subdivided by
C?
okay, wait. Fixed income index can be subdivided by market or economic sector to create more narrowly defined index. Comprises of corporate and asset. Yeah, market and economic to create more narrowly. Yeah, it should be C. C, right? Just check.
Yeah, it's C. C.
Yeah. See, why not A? Because comprises of corporate and asset-backed securities correct only, but it can also comprise of government
Yeah,
securities.
like
Anything,
both of them.
government
Like,
securities also,
yeah,
which is not mentioned here.
they're
Here it
limiting
says
it.
only government. Whereas because it says aggregate, it should be something broader one. Okay, which can be subdivided to narrower. Hmm. The next one.
30th one. Commodity index values are based on.
Commodity index values are based on future contract price. Yeah, commodity index are future contracts. The market price of the specific. Those are all derivative contract commodity index. The average, it's not the average price, market price. Future contract price. A. Okay.
It's C.
Yeah. You may check the answers. Okay.
Yes.
Yeah. Why it is A is because like in India we have MCX, that is multi commodity exchange. There, all those are what? All those are derivative contracts for commodities. So derivative contract is what out of all this? Futures. Okay. So basically people are predicting the future price of commodities there. You cannot take the underlying asset. It is all contracts only.
Yeah. Then 31st. 31st till 34th.
31st, which of the following is most accurate? Commodity index all share similar weighting methods containing the same underlying commodity offers similar returns. That you can clearly take this out, right? Not necessarily that they will offer similar returns. Acha, index containing the same underlying commodity. Okay, commodity indexes containing the same underlying commodities. Oh, okay. Offer similar returns. Acha, this is possible now. Commodity indexes. Commodity indexes all share similar weighting methods. No, not necessarily that similar weighting. This you can remove. The performance of commodity index can be quite different from that of the underlying commodities. Most accurate. Yeah, it should be C. Between B and C, A is clearly out. It should be B.
For B, like they can have different weightages, right? in B.
Hmm?
So like in B, there's in commodity indexes containing the same underlying commodities. So in one index, the weightage can be like much lesser or more.
Weight can be more or less according to the index. Value will change, but
So,
commodities
so the returns
price will not
cannot be
change. No,
same, right?
no, returns will be same only. The commodities return will be same, not the index's return. Entire index's return can change, but commodities return will not change. No, like imagine, let's say there is an index, gold is representing 20% of it, and gold's price is 100. Now it has gone to 110. So gold has given 10%. Individually, it has given 10%. Doesn't matter whether 20% is there or 50% is there. As an index, they will take only 20% of 10%. But gold individually has given 10%. No? Are they speaking about commodity or are they speaking about index? Commodity indexes
Like the
containing
answer
this.
is C over here, 30%.
Okay. Commodity indexes containing the same underlying commodities offer similar. Okay, that is. So here they are speaking about indexes,
So they
not
have
the
said
commodity.
the performance of commodity indexes can be quite different from that of the underlying commodities
Yeah.
because the indexes consist of futures contracts on the commodities rather than the actual commodities.
Mm-hmm.
Like, what are they saying?
That means, see, when you say commodity index, this index is representing all future contracts. So if I'm expecting that, today the onions price is, let's say, 50 rupees. Today onions price is 50 rupees. I'm expecting it to cross 100 rupees in a month's time. So in the derivative market, it will be trading at 100. Whereas in the spot market, it is trading at 50.
Okay.
Okay.
Next one. So,
30,
which of the
32.
following is not a real estate index category?
This is a memory based one. I think it is initial sales index, appraisal index, and repeat sales. These are there in the book directly. It's a memory based one. See, repeat sales, right? Appraisal.
So it is its initial sales index.
Yeah.
Like what type of indexes are these? Like, repeat sales index.
Repeat sales index will include only those real estate which has been sold multiple more than one times. And appraisal index is all new one. Okay, but I'm not getting that
And
here.
what is
It is
initial?
there in alternate investments, I think.
Which we didn't study it in equity, right? So like we
That's what I'm checking. Alternate investments, it is there. Uh, repeat sales. Yeah, it is not there. It is in alternate investments. It is in alternate investments. So appraisal index means new, real estate you are appraising, and repeat sales index means it includes only those which has been sold multiple times.
Okay, and what's initial? Like new project?
No, nothing like that. There is nothing like that.
Okay.
Mm.
So like initial is the odd
That
one
is
out.
that's why it is
It is
not
not
a
like
real estate index.
okay.
It's a pure memory only. These are two
So they've just made it up
indices.
like it doesn't exist,
It
like
doesn't have.
or
It
it's
doesn't exist.
theoretical.
No, no, no. It doesn't exist.
It's not even theoretical, right?
Yeah, yeah, yeah.
Okay. Oh, and then 33rd and 34th.
33rd. A unique feature of hedge fund index is that they are frequently equal weighted. No,
But why are
are
they putting
determined.
these questions in equities? These are like
Yeah,
all
this
very
is
basic
quite
ones.
quite unfair. Uh, I think slowly they will mix up all together or what, I don't know.
Yeah,
These are
like
all just, this is what
that's why I was so
they
confused. I was like, I'm
deliberately,
not getting any of these. I was like,
yeah, deliberately they are increasing the complexity. This is not the fair way to increase the complexity. It's an
yeah,
unfair way.
simply they're putting so many questions and like
Unfairly in different questions in different topics,
um,
different subjects. That's
and
very
now
unfair.
without even studying alternative
Mhm.
investments, who would know about that appraisal index and
Yeah,
all?
yeah, yeah. Yeah, actually, yeah. Okay, correct. That is right. I thought only derivatives they have added. Now I feel like many more things. Alternative investments also. All this.
They're jamming it up. Like,
How many more questions are there? Like this 33, this
yeah,
alternative. This is
34 is
also
the last.
alternative.
Yeah,
Okay, fine. Okay, only these two are there.
yeah,
Okay, then we'll
these
just
two.
finish it up. The unique feature of hedge fund index is that they are frequently equal weighted. No, are determined by the constitutions of the index, reflect the value of private rather than public investments, are determined by the constitution of the index. Unique feature are determined by, yeah, so it can be a mix up of anything. B, it should be
Yeah, the answer is B.
B, na? Because hedge funds can include anything. It is not including only private. They are saying only private rather than public. Here it says equal, nothing like that. It can be anything. Whatever kind of combinations you want, you can include in hedge funds.
Okay.
Okay. The returns of hedge fund index are mostly,
And A are
no, it is
frequently
equal
equal.
weight. No, nothing
There's
like that.
nothing,
No,
right?
nothing.
Okay.
Yeah. It should be upward biased.
Like, yeah, they would.
Upward biased. The
Yeah, I
returns of
see. I
hedge
see.
fund indexes are most likely upward biased one. Upward biased returns of hedge fund index are most likely.
To make it look
Uh,
better, right?
yeah,
That's what they mean.
yeah.
Like
Let me see what explanation they have given. 34.
34. So they have said voluntary performance reporting may lead to
Uh-huh.
survivorship bias.
Survivorship
Survivorship,
bias. Yeah,
yeah.
that's why. Survivorship bias means
Right, yeah.
whichever
They won't,
investments are dead, they are not
yeah,
accounting.
they won't include them,
Yeah,
right? They
yeah,
won't.
yeah. Okay. Next, then after this.
Third reading, page number, what is it? 152.
Hmm.
The the fourth one.
In an efficient market, the change in a company's share price is most likely the result of, yeah,
So, like, is it see new information coming into the market? Like in
uh,
an
in
efficient market,
an the
there
change,
would be no insider information.
new information coming into the market.
It would be C. Right?
Hmm. Because all these has been already priced, right? Private informations. All these are
And
has been priced, so it
and
should
if
be
it's
speak.
B, then it's not efficient, right? Like if
Yeah,
it's B,
yeah. Previous days, then it is
the
inefficient.
previous day's change in stock price, then like what is the situation here? Like if it's B, if the answer would have been B,
It is
like
inefficient market then.
like weak form or semi-strong form?
No, that's why we will say inefficient. It is
Inefficient.
inefficient.
Okay.
It is not efficient one. Hmm.
Then the sixth one.
With respect to efficient market theory, when a market allows short selling, the efficiency of the market is most likely to increase because more people will participate. So more efficiency will come in.
Okay.
Right? More flexibility it will bring in into the market. The next one.
Just, mm, 11.
Which one of the following statement best describes the semi-strong form of market efficiency? Okay. Which one of the following statement best describes the semi-strong form of market efficiency? Empirical tests examine the historical patterns. Security prices reflect all publicly known and available information. This is semi-strong. No? Semi-strong form efficient market are not necessarily uh, weak form. This one, security market price or publicly and available information. Semi-strong form market are not necessarily weak form efficient. No, it should be BB.
I think the answer was C. I'll check it.
Okay.
This is 11th one, right?
Yeah, just check.
Yeah. No, it's B. Yeah.
B.
It's B.
Yeah.
Security. And then 14th one. 14.
Okay. If markets are semi-strong forms efficient, then passive portfolio management strategies are most likely to. Okay. If markets are semi-strong, okay, if markets are semi-strong, uh, passive portfolio management strategies. Markets are semi-strong. Passive portfolio management strategies are most likely to earn abnormal, outperform active trading strategies. Right? They will do better than active trading
Okay.
because that's what the record shows in the developed market and all that you are not able to beat.
And they can
Uh,
also make abnormal returns, right?
no, they
They
will
cannot
not.
make.
Yeah.
It's only possible weak form efficient, right? Inefficient. Sorry.
No, you have to consider that semi-strong is inefficient. Then only you will make abnormal return. Same case, even see, suppose you are a trader, you are using technical analysis. Now
Yeah.
in weak form, you cannot make abnormal profit. But assume you are still making. That means the market is inefficient. So you have to change words like this. If you are making, see, in a weak form market, so the statement is in a weak form market, you cannot make abnormal profit using technical analysis. This is the statement, correct?
Yeah. Cannot make right.
Using technical analysis. Suppose if you make, then if you make, the market is inefficient. This market is inefficient. This
Okay.
this market is inefficient. You are considering this as inefficient. That's why you are attempting.
Right. Okay. And they've said one can
Similarly,
make abnormal profits using
similarly,
fundamental.
or imagine you are making abnormal profit in weak form. That means the
Yeah.
market is inefficient.
Okay.
Same case, even if it is semi-strong, you
Hmm.
cannot make abnormal profit using fundamental analysis. Okay, but imagine they are saying you are trying to do, or you are actually making, then that semi-strong market is inefficient.
Okay. Okay. Got
Ah. So here they are saying it is semi-strong efficient. If it is efficient, you cannot make abnormal profits using passive. Passive is just telling you that you are able to do better than traders. Okay, because it is efficient, no? So you cannot make abnormal profit.
it. Right.
Yeah,
It's B outperform.
yeah.
Yes. Yeah, it's B. And then
Next one.
16th one.
Technical analysts assume that markets are weak form inefficient here. Because if you assume it is efficient, you cannot make abnormal profit, and you are a technical analyst. So you have to change the word. This is what I was telling you. Because you are a technical analyst. If you are a technical analyst, you cannot make abnormal profit in weak form. So, but still you are doing. Then what does that mean? It is weak form inefficient market.
Yes.
Okay,
Got it.
next one.
Next one, 17th fundamental. And this is in the markets.
17. Fundamental analysts assume that markets are, again, same logic,
Weak
semi-strong
form
inefficient.
inefficient, right?
No, semi-strong inefficient.
Okay.
Because
So
you
they
are
said
you are
one can make abnormal profits using fundamental analysis and inside information in weak form EMH.
huh.
So they were expected like that the
So
market is
but
weak
weak
form
form is
inefficient.
inefficient. No, how can you
Yeah.
select this one? Weak form, see, in weak form inefficient, technical analyst will make abnormal profit.
Okay.
Fundamental analysts, anyways, they can make, even if weak form efficient market also, they may make abnormal profit, right? Only
Yeah.
technical analysts cannot make abnormal profit, no?
Okay.
So here fundamental analysts are making abnormal profit, means semi-strong is inefficient. That means C.
Okay. Got it.
Hmm.
That's the 18th one.
If your
The
market
market.
is weak form efficient, okay, market is weak form efficient. Okay, market is weak form efficient, but semi-strong form inefficient. Okay, semi-strong inefficient. Then which of the following types of portfolio management is most likely to produce abnormal returns? So passive portfolio management, no, active portfolio management based on fundamental analysis can make abnormal profit. No?
So is it C?
See,
Okay.
because it is semi-strong inefficient.
So yeah, fundamental. Right. Right.
Ah,
So 18th, it's C.
yeah, just 1 minute, okay, just 1 minute.
Yeah.
Hold on. Yeah, hello.
Yes, sir.
Which question now?
Just a minute. Just a minute. 20th one. If a researcher conducting empirical tests.
If you're a researcher conducting empirical test of your trading strategy using time series of returns, if you're a researcher conducting empirical test of your trading strategy using time series of returns, find statistically significant abnormal returns, then the researcher has most likely found significantly abnormal returns. Found a market anomaly, evidence of market inefficiency, strategy to produce abnormal returns. Then the market research, it's a market anomaly using time series of returns.
Like the market is not acting as it should. Is it?
Yeah, market anomaly,
Market
something
anomalies are like
abnormal,
all this
abnormal
January
happening.
effect and
Yeah,
all.
yeah, yeah. That because there's a time series, no? You keep checking the answer also.
So
Market
why like
anomaly.
what it has to do with time series? And then,
Market anomaly means market is behaving little differently without adequate reasons
okay.
at certain during in certain time of the year.
Yeah, like the January effect and
Yeah, 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 yeah,
20. Yeah, it's A.
yeah, 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 yeah.
And then 22nd, 22nd, 23rd, 4th, and 5th is 4.
22nd, which of the following market anomalies is inconsistent with weak form market efficiency? Which of the following market anomalies is inconsistent? Okay, so two are consistent with weak form. Inconsistent is momentum.
Momentum.
Yeah, because earning and closed-ended fund discount, those are all fundamental one. Okay,
Okay.
so weak form efficiency, inconsistent is momentum. Because momentum is a part of weak form and it is inconsistent. So which of the following anomaly is inconsistent with weak form, then momentum only is inconsistent then. Rest both are fundamental part or semi-strong. So fundamental as in semi-strong. So it is
No,
momentum.
what is earnings surprise?
Earning surprise means you expected the earning to grow by 10 percentage, it has grown by 15 percentage.
Okay. And closed end fund discount,
Closed ended fund discount,
like mutual
it's a
funds
mutual
trading
funds,
at a
yeah,
discount.
mutual fund trading at a discount to its net asset value.
Okay. So these two comes in semi-strong form, like it's semi-strong form inefficient.
Yeah, yeah.
23rd and
With respect to efficient markets, a company whose share price changes gradually after the public release of annual report most likely indicates that the market where the company trades is
is
receiving
C,
additional
is it C?
information.
Uh,
Uh, because it says slowly, right? Gradually after the public release, then it is not efficient. No, it is
okay.
receiving additional information about the company. Yeah, just check. This should be
Yeah.
because it is semi-strong. Efficient means it should quickly reflect. It is not efficient now. It is gradual.
So like
So it is
there's
receiving
insider
additional,
trading happening, right? We can see
receiving
that.
additional informations.
That's what they're trying to
Hmm.
see. Yeah, it's
Hmm.
C.
Yeah,
So if markets are efficient, the information from the annual report is reflected in the stock prices. Therefore,
yeah,
the gradual changes must be from the release of additional information.
yeah.
So we can say like traders, trading before the annual report, as in they knew
Huh?
something and they had invested before the annual report came out. Is it?
Huh? Say it again.
So like let's say there are some investors who had some like private information and they traded before the public this thing came out, the report came out. So that's why there's not much effect on the stock market, as in, on
Yeah,
the
yeah, yeah, yeah,
stocks.
yeah, yeah.
Like huge orders took place.
Yeah.
That's it. 24th and 25th.
With respect to rational and irrational investment decisions, the efficient market hypothesis requires rational and irrational investment decisions. The efficient market hypothesis requires rational and irrational investment decisions. The efficient market hypothesis requires only that the market is rational, that all investors make rational decisions, that some investors make irrational decisions. The efficient market hypothesis requires the efficient market hypothesis requires only that the market is rational, because all investors cannot be rational, and some investors will be certainly irrational. As a whole, market should be rational. Check, it should be A. Check.
Yeah, it's
A,
24th.
because only as a market you will see. You will not see about some investors, and all investors being rational is not possible. Okay. And some investors will be irrational, but as a whole, whether the market is rational or not, that is more important. As a whole,
Rationalism, like
that means you are believing that market, whatever they are valuing, they must have valued it correctly only,
okay.
because market is rational. As a whole, market is rational. That means right decision has been taken. Wherever the market has reached, it is correct. That's why if it gets overvalued also, the market will correct it, and when it gets undervalued, the market will lift the price further up, right?
Or 25th. Observed overreactions.
Observed overreactions in markets can be explained by an investor's degree of observed overreactions in markets. Observed overreactions in markets can be explained by an investor's degree of loss aversions, confident overreactions in the market. Basically, loss aversion it should be. Uh, just check. I'm not very sure for this one.
It's B, loss
The
aversion.
loss aversion.
They've said behavioral theories of loss aversion can explain observed overreactions in the market, such that investors dislike losses more than comparable gains. Risk is not symmetrical.
Yeah, with that means it is out of fear. That
Yeah.
overreaction is more out of fear.
Like they fear the same percentage of loss more than they would
Hmm, hmm.
love the gains.
Basically, out of fear, people tend to react more. Okay, that's
Okay.
what it means.
And why not confidence in the market?
Observed overreactions in market. See, the rate at which market goes up, that is lower than the rate at which market falls down.
Okay.
It falls down more sharply.
Right. Got it.
Next one.
Or done. Like there were 26 questions. I got the 26.
Okay, next one. You have questions?
Yes, sir.
Question number.
The third one.
All of the following are characteristics of preference shares except preference shares. They do not have voting rights, correct?
Hmm. They are either
They,
callable.
they do not share in the operations, operating performance. Uh, yeah, callable or puttable. They generally do not have voting rights. This is correct. They do not share in the operating performance of the company. That is also correct. So they are callable, puttable? No. All of the following are characteristics of preference shares except they are callable or puttable. Yeah.
A.
Yeah.
But it can be
They they
callable, right?
they uh,
By the company. Like we'll call it at so-so price. So,
that is not a must feature,
okay.
right? It is not a must. These are all must feature, that no voting rights and they do not share in the operating.
Yeah, is correct. Preferences do not have to be either callable or putable. Like there is additional thing. Yes.
Let's see what they have mentioned.
The only one line that said about it.
Preferences do
We
not
do not
have
have.
to be either callable. That's what, like, it is not a must
These are additional thing that the
features.
features. Okay.
Yeah. The next one.
Just a minute. Six. Eighth one. So can we continue tomorrow?
Yeah, okay. Okay, then should we stop now then?
Yeah, sir.
Okay, all right. We'll continue from here tomorrow then. Okay. We'll stop now.
Yes, sir. Thank you, sir.
Okay.
Bye.
Okay.
Thank you, sir.